There's a retirement account that lets a small business owner legally shelter up to $265,000 a year from taxes every single year. And your financial advisor has almost certainly never mentioned it to you. Not because they forgot, because they didn't bring it up. Most people think the retirement game has two moves. You open an IRA, max it out at $7,000 a year, or you put money into a 401(k) and hit the $23,000 ceiling. That's it. That's the whole board. That's what schools teach. That's what the commercials show you. And while the average person is putting away $23,000 and feeling responsible, a business owner down the street is sheltering 10 times that amount and paying almost nothing in taxes on it. The strategy is called a defined benefit plan. And yes, it's legal. Yes, the IRS approves it. And no, nobody taught you this. Here's what it actually is. A defined benefit plan is the original pension, the kind your grandparents' employers used to fund. But here's where it gets interesting. You don't need a big employer to set one up. If you own a business, you are the employer. You create your own private pension, fund it yourself, and take a tax deduction for every single dollar you put in. That's the part they skip in the financial literacy class. Here's how it works. You set up the plan through an IRS-approved document. Then you hire an actuary, a specialist who runs the math to calculate the maximum you're allowed to contribute each year. The formula is based on two things, your income and your age. The older you are, the more aggressive the limit because the actuary is working backwards from your retirement target date. Let's put a real number on this. Say you're a 52-year-old consultant. Your business earns $400,000 a year. A 401(k) lets you shelter $23,000. Maybe $69,000 with the employer match included. But a defined benefit plan, depending on the actuarial projection, you could qualify to contribute $180,000 to $220,000 this year alone. Every dollar deducted from your taxable income before the IRS ever sees it. Run the math. At a 37% federal tax rate, a $200,000 contribution saves you $74,000 in taxes in a single year. Not over a career. This year. And this isn't even the best part. The wealthy have known about this for decades. Hiring doctors, attorneys, consultants, real estate investors who have elected S-Corp status, these are the people quietly maxing defined benefit plans. Their accountants bring it up every October during year-end tax planning. Their financial advisors don't. And that distinction matters because financial advisors typically earn commissions on products they sell. A defined benefit plan is a structure, not a product. No commission, no incentive to mention it. The school system teaches you to invest in a 401(k). The wealthy invest in the plan their accountant designed around their specific income and tax situation. Now here's the part that sounds like a catch, but isn't really. The IRS does require you to fund the plan consistently year over year. You can't open it in a windfall year and ignore it when revenue drops. It costs a few $1,000s up front in actuarial and legal fees. And you're committing to a structure with rules about how and when you can withdraw in retirement. But the IRS isn't trying to stop you from using this. They created the form for it. They published the contribution guidelines publicly. This strategy exists because Congress decided that business owners who create jobs and take on risk deserve a retirement vehicle with real power behind it. The law was written for you. You just weren't told to read it. Here's the implication that should stay with you. If a retirement account that shelters $265,000 a year exists, and it does, and it's completely legal, and it is, and most people have never heard of it, then the question isn't whether this is real. The question is, what else is out there that nobody mentioned? The system isn't hiding this from you out of malice. It just has no financial reason to show you. Your employer doesn't benefit. Your broker doesn't benefit. The platform running the retirement commercial doesn't benefit. You benefit, but only if you know it's there. And there's a move that pairs directly with a defined benefit plan, a strategy that takes the money you've already sheltered inside it and converts it into a tax-free inheritance your kids never pay $1 of income tax on. Most accountants won't bring it up unless you ask the right question. That one's in the next file.